Most people think the housing market is just about timing. Buy low, sell high, but what if the real win is staying in the game long enough? You don't need a crystal ball, you just need a 30-year mindset. And today, we'll show you exactly what that looks like.
We've had versions of this conversation many times, Jeb, either in person or here on the show. But Lance over at Resi Club Analytics, they did a really cool article. They looked back and said, let's take a peek at buying a home in March of 1994. And what does that look like? Now, past results are not a guarantee of future performance, but we're going to look at that and we're going to see how it worked out for people over that time frame. And we're going to project forward what's likely to happen over the next 30 years. So first time buyers today, if we get 30 years down the line in 2055, as awful as that is to think of the year 2055, where is it going to put you? If you're a median first-time home buyer, 35, 36, 37 now, so you're right there at retirement age, mid to late 60s, where is it going to put you? Because it's super easy. People, Reddit, forums, social media, everyone, oh, these people had it so easy back in the day. So let's look at that buyer who bought in 1995. Many of you don't know, but even here in Southern California, we were in the middle of a downturn at that point in time. And there were people who said real estate will never be a good investment. That was for your aunts, uncles, grandparents. They made money because they bought super cheap and now they've gone up. No one will ever make money again. Don't buy a house. Actually, one of my mentors, Bruce Norris, an investor out of Riverside, California, he wrote a book in 1997 called The California Comeback. He said why home prices will double by the early 2000s. People thought he was nuts. They're like, you're nuts. That's never going to happen. People are never going to buy houses again. So what did that 1995 buyer go through? They had to get through this same thought process that it's not the investment that it was. I'm not going to make what my parents and grandparents made on it. They went through the tech wreck and a housing recession in 2000. Their 401k got beat up. Interest rates spiked before dropping. They went through the mother of all run-ups in home prices and the flip side of that, the great financial crisis, the great recession, and a bubble there in housing prices, and saw homes come down a lot in large parts of the country. Then get through just the last 5 years, they get the pandemic, they get the bubble, QE 2, 3, 4, QE infinity, ultra low interest rates. So they've seen the entire spectrum. It wasn't the best of times, like a lot of people want it to paint it out to be. At periods of time in the last 30 years, it was the worst of times. But overall, we're going to see it's worked out really well for those people, which most people only look at the end result. They look at, hey, my mom and dad bought in 1994 and they're sitting here with their home free and clear and they have a ton of equity and everything's great. But there's truth to that. So we're going to go through a lot of that. And the big one that is easy to focus on in most of the country, if we look at the national numbers, it's about a 300% increase in home prices over that last 30 years. California, Washington, other parts that have done very well over that, as much as 400%. Other parts of the country, maybe only 200, 210, 220% increases in values. But anyway, you cut it. The easy thing is to look at and confirmation bias and go, yeah, you bought it at the right time and everything took care of itself and the home has appreciated greatly. But that's the easy story, right?
Sure. And we're going to talk about how it compares to the stock market as well, right? Because there's always that comparison. Well, hey, I could have done I put the same amount of money in the stock market and gotten an 1,800% return over that same period of time. So we're going to talk about what that looks like. But I think what's important from today's episode is when you hear Josh and I talk about real estate, you often hear us say one of the things that you have to think about when buying a home in this market, any market, is that longer term time horizon. Now, we typically say 5 to 10 years is where you need to have that minimal mindset.
That's your minimum. Your minimum.
But when you think longer term, that's where the real benefit here lies. I mean, it's easy to get on YouTube or any of these other things and hear investors and different people talking about buying and flipping and buying and turning it over and buying the next house and this the BRRRR strategy and all of these different things where it makes it sound like, hey, you just buy a home and it's going to go up in the next one and you just keep, it's this little game of Monopoly. And the reality is that's not how it truly works. It can work that way, but when you step back and you take it from this longer term perspective, which is what we're going to do here today, I think you see the real benefit. You have to have a roof over your head. So why not have a roof over your head and benefit and create that long-term generational wealth while doing it?
Well, let's dig into those two numbers. The rent Inflation in rents over the last 30 years.
Sure.
Inflation. We just talked about inflation in home prices. You talked about appreciation, increases in the stock market. So the median home price in 1995 was $130,000. Median interest rate in March was 8.53, according to the Freddie Mac Primary Mortgage Market Survey. So if you put 5% down, you had about $1,000 principal and interest payment. Taxes and insurance, depending on where you are in the country, is going to add plus or minus another $200. So you buy that house, have a $1,200 monthly payment. So I know for us here in Southern California at that time, that house would rent for a little less than that, $1,000. So when we say today, people go, well, why would I do that? It's 25, 30, 40% more to own a home than it is to rent. It's not like it was back in the day. It's always been that way, at least in Southern California. So we talk about other parts of the country. There are parts of the country and times when you can own for less than renting. So that's what it was. I got in the business in 1995. So we are talking about literally when I first started learning mortgages. And that was the way I was looked at. There was a little bit of a premium. So in this situation, 20% premium to own versus renting. So when we look at what would that do to acquire that home, we can either say 3% down with another 2% for closing costs would be 5%. It's about $8,000 on that $130,000 home. Or we could say put 5% down, seller pays your closing costs. With an $8,000 investment, you could have controlled that. So we talked about this. It's a little less than 4% appreciation over that 30 years annually. So when we look at that, for $8,000, your home value now is about $420,000. So that median went from $130,000 to $420,000. So you got $298,000 of appreciation there in the home. It's about, like we said, 3.83% a year. You're like, well, that's not a great return. For $8,000, you turned it into $298,000. But then we have sort of that second component there. And I was saying, before we move on to that, let's say if we said, no, I'm going to rent. Let me put the $8,000 into the S&P. I never take it out, and I perform exactly what the index does over that time. It's up a little over 10%, 10.09%. You'd have $160,000. So 8 to 160 or 8 to 298. But wait, we've got another component there. If you had invested that money, you needed to rent the entire time. So that $1,000 a month rent, if we look at, it's also increased annually a little bit less than 4%. It's like 3.7% annually. Now that $1,000 is like $2,500, $2,600, $2,700 in rent, depending on where you are in the country. So when we're looking at that, that is a massive, massive increase. It's actually like $3,200 a month. So it's a tripling of what that rent would be. Whereas the person that owned, they fixed that. Not only did they fix that, over time, we're going to talk about their ability to bring it down with refinances. And if they didn't take cash out and they didn't keep extending their term, which, let's be honest, most people did through that time frame, either used the cash for home improvements, college education, whatever. Most people did do that. But if they didn't, they would have no payment now other than the taxes and insurance, which went from probably $200, now it's $500 or $600. But that is to compare to renting that house for $3,200.
Well, the one thing you didn't factor in there, Josh, is when you start going, I mean, and we're going to talk about it, is you paid down the principal of that, balance every time you made your mortgage payment, right? So I know keyboard warriors are out there. Well, in the first 5 years, you're paying very little principal. Okay, true. You are paying very little principal, but renting, you're paying nothing toward the principal. So you paid down the principal, you got that appreciation that we talked about, the 290 something thousand. But while renting, if your rent was $3,000 at the end of that 30 years, that's $36,000 a year. So you can backtrack it all the way and do the math for whatever numbers you want over that period of time. The reality is, if you were paying rent and you got $160,000 in gain, you probably made no money. You actually probably lost money in that deal once you factor in all of the rent during that period of time. So apples to apples. So what do you prefer?
So, and really, we can debate, and reasonable people do, what's the biggest benefit of home ownership? And to me, it's fixing that housing cost. When I bought my home, we probably could have rented it for somewhere between $2,500 and $3,000, and my payment was about $3,200, $3,300 a month. So you're like, that's reasonable. I'm paying a little bit of a premium, but the majority of it's going towards principal, forced savings. But today, that same house, I've refinanced. We've taken cash out. We've done massive improvements to the property. It's much nicer than when we bought it. Interest rate is much lower. Payment is lower. Yet to rent in my neighborhood is almost $6,000 for a house like that. So you go, if I had rented all those years, I better have been earning really strongly, saving and investing very well. And the reality is, one of the benefits of homeownership versus investing in the market is the transaction costs, the getting in and out of the market are really difficult. And the fact that you need a roof over your head, most people will stay in the home. We say 5 to 10 years. Most people do stay in the home. Tenure in average tenure in homes dipped during
11.
COVID, but it's 11 plus years, right?
Yeah. It's around
So
11 years.
rarely did someone buy an S&P index fund in 1995 and leave it alone for 11 years. They panicked. They freaked out when it dropped 20% in a week. They freaked out earlier this year and they sold when it was down 15, 20%. And now we're back positive for the year. The transaction costs and the ease of pushing buttons on a keyboard, which it wasn't quite as easy in 1995, but today, very easy to move to cash and miss gains when you're trying to avoid further losses. So the benefit of it is fixing that housing cost, forcing yourself into that forced savings every month of the principal payment, which admittedly is low in the early years and massive in the late years. But that key thing to me is fixing your housing cost, because today, no one can argue almost anywhere in the country, it is vastly cheaper for you to rent, even apples to apples. Buy this house or rent a very similar house, much cheaper to rent for most areas of the country. But within 10 years, probably within 5 years, that will not be the case. So you have to take the long view and look at it. If you're serious about building wealth, you have to take the long view and say, when is it right for me to enter in here and start working on fixing my housing costs, getting that 30-year mortgage amortizing so that I do get to the end of the rainbow. Again, if most first-time buyers are closer to 35 today than 26, 27, 28 like they were in 1995, then we're looking at 65 years of age before you get it paid. If you don't move up, buy another house, refinance, take cash out, start the term over. So these are all important strategic things that you need to do, and important things that you need to be working with advisors, both your realtor and your mortgage professional, that help you see this, rather than going, hey, rates dropped to 0.5%. You want to refinance? Oh yeah, I do. Okay, cool. Your payment's going to be $300 lower. Well, we're starting back over at 30 years. I charged you 2 points. We rolled it into the loan. You owe more than what you started with. It is very important. Like, people get focused on, I'm going to shop around for the lowest rate. They don't look at the best package, the best structure, what's going to work for them over the long haul. But this is what it means to work with advisors that have your best interest and the long view of trying to help you arrive 20, 30 years down the line with optimal, maximized wealth. And for most people, let's be honest, our audience, we're not trust fund babies. We don't have people that are going to wake up and have $15 million when they retire, but it's how do we have a free and clear home and $1 million or $2 million in our 401k over a 30-year time frame. And that may sound crazy to you today, but if you're 35 and looking to buy a home, very, very realistic if we strategically approach this and focus on maximizing our earnings through taking our career seriously, saving by not getting over our skis and spending too much money and doing crazy things, and investing wisely, including buying a house and fixing your housing costs at some point.
Yeah, I mean, I think the average at the moment, first-time home buyer is 38 years old. So a little bit older than what you said. So 3 years older. But the earlier you can do this in your life, right? That's the average. The earlier you can do this in your life, the better off you're going to be. I mean, the key is that most people earn more every year of their life, right? Your wages should go up. So the earlier you can do this and be comfortable with it, the less this is going to be of your budget overall, right? So if you continue to make money, your housing cost is fixed, that's a benefit, right? Because then you have additional funds coming in, and hopefully additional funds coming in, putting those away. And then talking about the opportunity cost of refinancing, Josh, if you get some sort of tailwind, right? Right now we're at the higher of where rates have been over the last 15 years or so. The likelihood of them moving lower is high. How much lower? To be determined at the moment. But the reality is, people that are buying now, buying over the next couple of years, are likely going to see lower rates at some point. So if you can get in sooner, fix that housing cost now with your with being comfortable, not this idea that, hey, if rates come down, then I'll be comfortable. Buy it being comfortable now, but when that opportunity comes, assuming your job still allows you to, you have the equity, you're able to refinance, take that payment down, hopefully keep the term of your loan the same. It's a massive benefit, right? Because then you stay on track, you pay off that mortgage over time, you approach retirement without having this burden, if you will. Whereas the renting side, the burden is still there. You got to figure out what happens at the end of the day. So, and this isn't a push to get anyone out to go to buy a home. I think it should be very, very clear on that. And I know it can seem like that. It's just, these are the benefits. This is what we see every day. We've both benefited greatly from real estate, and so I think it's, we're trying to relay that message to you guys.
Well, big picture. What have we always said, and we lead the webinars when we do these with this, is that everyone should own a home. But that doesn't mean that everyone should buy a home today. The entry point has to be right for you on a million different levels. So big picture, these are the things that tell us that owning your home is the right financial decision for the vast majority of people. And Jeb, a slightly different angle at that refinance look at it, is that, again, if you bought a 1995 at 8.5%, in the early 2000s, that person, even with their little loan, so we say $125,000 loan, that tells us at that time, using our rule of thumb, 125,000 divided by your loan amount, they needed to save 1% before it made sense to refinance because the loans were smaller. So when we look at that, by the early 2000s, they got a chance to refinance to the low sevens. By 2009, we had that first round of QE. They got a chance to refinance to low fives. And then through COVID, whatever mortgage they had left, if there was still enough there, if they had taken cash out, under 3% or at least into the low threes. And Bill McBride threw an article up at Calculated Risk a few weeks ago, and he was talking about how people don't realize this, but it's very similar to that same time frame, in that we're at 6.75. So we're not all the way up to 8.5 where they were then. And we're also probably not likely to get all the way back down to 2.65 or wherever the lowest was that we hit in 2021. But 6.75 with a $400,000 mortgage, if you can get it to 6.25, makes all the sense in the world. If it drops another 0.5%, you get it to 5.75, all the sense in the world. So I think it's reasonable to look at, if you're saying over the next 10 years, very possible that people have 1 to 2 refinance opportunities to get it down 1 to 2% lower than what they're entering at today. All the while they're taking their payment lower, renters are seeing that the temperature on the thermostat just getting turned up slightly, 3% a year. 3% a year, 3% a year. So from that perspective, that's where the fixed cost and the optionality of being able to refinance, should you have that opportunity. Your worst case, you fixed it and you're not subject to rent increases. Your best case, you have the option to lower it.
Well, and I think it's also important to understand, like, insurance costs are getting higher in some areas of the country. Taxes are going up in areas of the country. Us here in California, we benefit from Prop 13. But understand that, as those costs go up, the landlord doesn't just eat it. They don't take it in the shorts and say, well, the insurance went up, I'm just going to eat that now. They pass that along, right? So that is constantly getting passed along to the tenant. So yes, you're fixing your housing payment, and in some areas of the country, you're still going to have taxes and insurance creep up annually, but that's going to happen with rent too. So we're not ignoring that fact. It's just, it's important to point out that, either way, we're using an average of 3%. Some areas of the country might be getting 5-6% increases in insurance. But Josh, what happens if you buy at the peak? What happens if you buy at the height in home prices? You bought in 2007 and 2006, and you paid the most expensive number for your house, and or you bought when interest rates were 8%. What does that look like?
So let's use the example that we've talked about a million times. My wife's best friend, her parents came to me in 2006. They wanted to buy a house. They had rented a home very similar to the ones we're talking about for the better part of 15 years. They ran the numbers. They had paid more in rent than it would have cost them to own the home. They said, this is dumb. We're 40. We want to get into a house. We want to get a mortgage. We're going to pay it out over the next 30 years, and we're going to have a home free and clear when we retire. So I went through with them for a million different reasons. We were looking like this is a very dangerous entry point, very different than today. There were reasons to look around and go, this is not sustainable. I talk about Bruce Norris, again, one of my mentors in the space. He was one of the first ones pointing out that we have normal levels of affordability, the Housing Affordability Index that the CAR, that the National Association of Realtors runs, and we've gone way past those in that time frame because we had stated income loans. You could say whatever you make, so we didn't have the affordability constraints that we have today. So because of that, we told them, hey, this may not be the best entry point. I actually believe that prices are going to come down fairly significantly from here at some point. They said, we don't care. We have a long, long view. We're going to buy this house and be here for 20 plus years. So of course they did. They paid a little over 600. At the worst case, it had a 3 handle on it. It was 3 something. I don't know if it was 350, 375 was what that house was worth. And eventually it got back above water like everyone else did. Eventually they refinanced. They have a 2.5 interest rate on it now. And that home is worth $1.2 million. So again, past performance is not a guarantee of future results. So I don't think that we're ever going to see a correction like we saw in 2008 to the downside. I don't think we're ever going to see a boom like we saw during COVID again. So they had the downside, and they kind of got the catapult there at the end, and it worked out very well for them. So with that, Jeb, why don't we transition to saying, you don't have a crystal ball. I don't have a crystal ball. We don't know what the next 30 years look like. But it's going to be different than the last 30 years. We talked about similarities here of people saying today a lot of the same things that they were saying in 1995. Homeownership doesn't make sense. Your parents are the ones that made all the money. No one's ever going to come out ahead. But there are some significant differences. So when we look forward over the next 30 years, there were 2 major tailwinds over the last 50 to 60 years that are not going to be there anymore. The first one is the obvious one that most people are aware of. In 1982, so 10, 12 years before we started this 30-year window that we're looking at, rates were 16, 17% on mortgages. And most of those were adjustables in the 14, 15% range. But we ran that down to, like I said, the lows at about 2.65 over 40 years. That's a massive tailwind. When you look at the same home financed with a 15% mortgage versus a 3% mortgage, obviously the value of that is going to increase because controlling it, owning it, living in it is much more affordable. It uses less of your household income. So we're unlikely to see that. But we've seen this run up in interest rates. We at one point were almost 8%. Some borrowers were at 8%. So if we say in this window here, the high was 8, low 8s, we're probably not going to get back to 2.65 because that was government buying of both treasuries and mortgage-backed securities pushed rates lower. Because of the deficit situation, we are unlikely to be able to, even if the government wanted to buy bonds like that again in the future, they can do anything they want. There would be serious repercussions to it. I don't think that's going to happen. So is the floor going forward 3.5%? 4%, 4.5%. Before that COVID round of quantitative easing, Jeb, people forget we were pushing the high 3s. We were already into the low 4s, working our way to the high 3s before the government started any bond buying. So let's call it 4%. Let's say the high was 8. You do have a potential of that window of some improvement, but that pales in comparison to 15% down to 2.5%. So that tailwind is unlikely to recur, even though we're likely to get some benefit of that. The second piece, Jeb, that most people completely forget about is the change from single income households to dual income households over, say, from the mid to late 60s through the early 90s. That was when we generally saw that tradition. In 1960, 25% of married couples were 2 incomes. 75% of generally moms stayed home. By 1980, it was up to 45%. So 20% of moms, 20% more of moms had gone into the workforce. That peaked at around 60% in 1997, and it's been 55 to 60% there. But we talk about affordability isn't just debt to income ratio when you go from income as 1 income earner to 2 income earners. So we had that increase in household incomes at the same time the financing costs were coming down. So when we say we're at 4% over the last 30 years, and in areas like Southern California, it's more than that, over 5%. We're probably not going to see that going forward. So if we go into it expecting a repeat of the last 30 years, it's unlikely to be the case. You are going to have the chance, likely going to have the chance to refinance a few times and lower that cost. You are going to see appreciation, but I think it's more reasonable to look at appreciation somewhere slightly above the rate of inflation. The government wants to see that at 2%. It's been the high 2s for the last 12, 18 months. So if we say 2.5 to 3.5%, we can plug all these numbers into the spreadsheet and it still works out to put you in a massively better position as a homeowner versus someone renting. So that doesn't mean that you don't have to save and invest, that you don't have to have a 401k, that you don't have to put money in the stock market. The right answer is do all of them. And most importantly, is timing your entry into the housing market. It means not having FOMO and not jumping in too early and doing it when it's too risky, but also not being scared and sitting on the sidelines and waiting till it's too late because you're reading the headlines that are scaring the crap out of you.
Yeah, I mean, it's all about buying when it's the right time in your life, right? And so over the last 15 or so years, we had a big push in demographics. We had building was low. Builders weren't building as many homes coming out of the Great Recession, and so you had some again additional tailwinds kind of pushing home prices up. A lot of demand was pulled forward because interest rates were lower than expected. So people that were buying in 2021, 2022 probably weren't actually buyers until 24, 25, maybe even next year. But with affordability improving so much, those people became home buyers earlier in the process. So you had a lot of demand, relatively low supply in most of the country, and it drove prices up. Right now, what we have is interest rates are a little bit higher, buyer demands, down. You got inventory increasing in a lot of the areas of the country. But we're still, we still have this demographic push. We have the next generation coming, and they're starting to turn prime buying age, and they will over the next 10 to 15 years. And yes, there are boomers out there. Boomers are going to retire. They're going to sell homes. A lot of them are going to leave them to family members who are going to keep those homes. Some are going to sell. So there's a lot of different things going on that's likely going to keep appreciation somewhat suppressed, if you will. But the reality is people need homes. There's not enough of them, and you have to have a roof over your head. And it's not about looking on Zillow or looking on foreclosure websites and figuring out when you can get it at the bottom of the bottom price. It's about buying it when it fits your lifestyle, the payment makes sense, you got money in the bank, you have that longer term time horizon, and then magically you look back and you go, whoa, what the hell just happened? That's me, Josh, bought in 2012, the last, the property before this one, and go, you know what? I didn't really think about my home price very much. I just made the payment every single month and then magically looked up 12 years later and go, dude, this thing almost tripled in value. Yeah, there was a lot of factors that went, that added to that, but holy cow, like nothing that I planned to do. I didn't try to time it. It was, hey, the right time. Here we are today. So if you're in that position, you're thinking about the process, you're looking where to start, how soon can you start? Never too early to start the process. You can reach out to Josh and the team using the link in the description of this video. It is theeducatedhomebuyer.com/start. We'll get you in touch with the team. If you need an expert real estate agent anywhere in the country, I can help you. Just use that same link, and we're happy to get you in touch with somebody that does business like me or me directly. And Josh, parting words on anybody that's considering becoming a homeowner.
I will leave everyone with this. Again, the decision is not should I be a homeowner, it's when should I become a homeowner. We talk about it a lot. We have other episodes here where we walk through the things that you have to answer. Am I stable in my work, career, my location, so that I have that 5 to 10 year time horizon, relationship? When you've checked all of those boxes, it's time to at least have the conversation, to look at numbers and see what it looks like. Where are you today? Where do you need to be? If there's a gap, what do we have to do? Is it saving more money? Is it getting a promotion? Is it getting a higher paid job? It lets you know where you need to be to get to your goals in life. Our audience, the people that are listening here, smart people, upwardly mobile, want to educate themselves and see things as possible. So all of this is possible. So even if what you want and need is not possible today, it is possible. You just got to get a plan together and go pursue your goals.
And we would love to be part of that plan. So make sure you reach out if we can help. But until next time, make sure you buy right, borrow smart, build wealth. Adios.
Amigos.